Thank you, Kiara. Good morning, everyone, and thank you for taking the time to attend the call today. We will now take you through the results for the full year ended 29th of June 2025 and a trading update for the first 7 weeks of the H1 FY26 year. There will be an opportunity to ask some questions at the end. Accent again delivered sales growth and profitability in the FY25 year. I'm pleased with the Accent team's ongoing focus on our customers, product innovation, and high standards of retail execution, online and in stores. We continue to make progress against our strategic objectives. If I can now refer you to the operational highlights on page 4 of our investor presentation, which was released to the ASX this morning. The key highlights include the opening of 54 new stores, bringing the total number of stores to 903, inclusive of our online websites. Vertical owned brands and product sales have grown to more than $130 million, a mix of around 9% of our total sales. New distribution agreements signed with Lacoste and Dickies, with Merrell and Timberland agreements also renewed for further terms. Our long-term Skechers distribution agreement was extended to a 10-year term out till 2035. Skechers is our most important distribution agreement, where we currently have more than 200 stores and a large online and wholesale business. In April, the company signed a long-term strategic partnership with the Frasers Group to bring Sports Direct stores to the ANZ region. I'm pleased to report that the Sports Direct rollout is on track, with our first store due to open in Melbourne in November. I will now hand you over to Matthew Durbin to talk through the details of the result.
Thanks, Daniel. Coming on to page 5, total sales for the year, including TAF franchisees, were $1.6 billion. EBIT of $110 million was in line with prior year, and at the upper end of the guidance of $108 to $111 million provided in the June trading update. Inventory levels were in line with plan, with aged levels clean. The year-on-year increase in inventory reflects the timing of stock in transit, converting TAF franchise stores, and inventory acquired in conjunction with the Frasers transaction, along with opening inventory for Lacoste and Dickies. In terms of the summary of financial performance on slide 6, gross margin was down 85 basis points to 54.9%, reflecting the more promotional consumer environment and in half two the impact of lower sales and disciplined approach taken to managing inventory. Cost of doing business of 46.6%, including lease depreciation and interest, was an increase on prior year, arising from low LFL sales in half two and continuing inflationary pressure in store team wages and annualising rent reviews. Net profit after tax was $57.7 million. Coming on to retail and wholesale on slide 8. Owned retail sales grew by 2.5% to $1.3 billion. During the year, 54 new stores were open. New store performance remained strong, with sales and return metrics in line with expectations. Of the 57 stores closed or divested, 39 of these related to divestments and discontinued brands, with a further 18 stores closed where sustainable renewal terms could not be agreed. Wholesale sales of $155 million reflected the challenging macro and consumer conditions in the broader lifestyle footwear market. Sales of vertical owned brands and products grew to nearly $130 million, continuing to improve underlying gross margins. The key contributors to the growth were Nude Lucy, Nils, Stylerunner, and Ode. Turning to the growth plan on pages 9 and 10. The company continues to have a strong pipeline of growth opportunities. The Sports Direct rollout is on track, with the first Australian Sports Direct store planned to open in Melbourne in November. At least 4 stores, including online, are planned in FY26, and at least 50 Sports Direct stores are planned over the next 6 years. The Lacoste and Dickies distribution agreements both commenced on the 1st of July, with sales starting to grow in FY26. There are further store rollout opportunities across the portfolio, with at least 30 stores, excluding the Sports Direct, planned to open in FY26, including more new stores in Skechers, Nude Lucy, Hoka, Stylerunner, and others. The all-important Skechers distribution agreement has been extended to a 10-year term out till 2035, reinforcing the position that Accent holds as the distribution partner of choice for global brands in the ANZ region. The Athlete's Foot franchise reacquisition program remains on track. On an annualised basis, the 15 TAF stores reacquired in FY25 generated around $43 million of sales, all are strongly profitable. A further 13 reacquisitions are planned in FY26. Turning to dividends and the trading update. The company has announced a fully franked dividend of 1.5 per share, bringing total dividends for the year to 7 per share. The full year dividends represent a payout ratio of around 70% of earnings per share for the year. Total owned sales for the first 7 weeks of FY26 are up 2% to last year. Like-for-like retail sales for the first 7 weeks are up 0.8%. And for the year, the company is targeting low single-digit EBIT growth in FY26. This is inclusive of the startup costs expected to be associated with Sports Direct. The outlook for half 1 FY26 EBIT is for a similar level of EBIT to half 1 FY25, with growth in half 2 FY26. This target is based on achieving low single-digit LFL sales growth from new and annualising stores, incremental profit from the Athlete's Foot franchise acquisition program, new distributed brands, and continued growth in Hoka and Nude Lucy. Gross margin percentage and cost of doing business percentage are planned to be broadly flat to FY25, and the projection includes the impact of startup costs for Sports Direct. Now back to Daniel to wrap up.
Thanks, Matt. We are pleased with trade in the opening weeks of FY26. In particular, the return to positive like-for-like retail sales growth. Wholesale sales have traded in line with prior year with strong forward orders. We're very pleased with what's happening in wholesale. The Accent team is focused on executing our plan for FY26, including innovative new product, new stores, launching Sports Direct, growth from our existing and new distributed brands, and a continued drive on cost efficiency underlining gross margin improvement. The Sports Direct rollout, in particular, is a major growth opportunity for our company over the coming years. Finally, I would also like to take this opportunity to personally acknowledge and thank our chairman, David Gordon, for his support, leadership, and stewardship of the company over the past 19 years. David has announced his intention to retire at the company's AGM in November, and we wish him all the very best for the future. That concludes our presentation today, and we would be happy to take any questions. Thank you.
Thank you. We will now begin the Q&A session. As a reminder, if you would like to ask a question, please select the raised hand button to be placed in the virtual queue. Our first question comes from Garth. Garth, please go ahead and unmute yourself to ask your question.
G'day, can you guys hear me?
We can. Thanks, Garth.
Terrific. G'day. Congratulations on the results. Thanks for taking my questions. Just on the trading update, could you just sort of break down the difference in the lifestyle and the performance of lifestyle and the performance of your performance banners? Just the performance had previously been quite strong, and I just wanted to assess whether that was still lifestyle that was dragging that down.
Yeah, Garth, thematically, that trend continues. So, the banners like the Athlete's Foot, Hoka, and Merrell, this is a trend we've talked about now for at least 12 months, continue to perform strongly. And the more lifestyle-oriented banners are definitely softer in terms of the growth. Albeit, as we called out, what we're starting to see is a strong forward pipeline of wholesale orders, which gives us confidence as a forward read that some strength might be returning in that part of the business.
Okay, great, thanks. And then just on that, I think the inventory growth was well above the revenue growth. how confident are you that you're not going to have to discount with that stock that you've got? I mean, I know you mentioned it was clean, but is that just related to the new store openings, or is there something that we need to just be conscious of there?
No, there's no issues in terms of the composition of our inventory or the levels. And that's why we specifically called out the sort of year-on-year, I'm going to say one-off impacts, which is new inventory that's coming in for the Athlete's Foot franchise stores that have converted. We've got opening inventory levels from Lacoste and Dickies, which will translate into sales. And we haven't made much of a deal about it. We acquired quite a bit of inventory, which you can see in our combinations note there as part of the Frasers deal. Part of which will be inventory for Ozsale and part for Sports Direct.
All right, terrific. And then maybe one more, if I can. Just theft has been an issue with one of your peers that was called out yesterday. Are you seeing similar levels, and is that have you sort of had to factor in any measures to protect staff and stock?
There's two aspects to that, Garth. I might just talk to the financials around shrink, and then Daniel can talk to the team. But we're not. It's a bit easier for us, I think, than others. We're very diligent on it, and when you've got one shoe out on the wall, we're a little bit more protected in the way our business model works. So we're not seeing any dramatic increases in shrinkage, to be honest, in our business.
Terrific.
And
Thank you.
on the people side, Garth, absolutely. We're spending a lot of time making sure that our team is safe. We're doing all we can to, advise the shopping centres in the main landlords that more has to be done in this space, and hopefully it all goes away for everyone. But certainly been a little bit of a spike, but we've not had incidents that we've heard that others have had to date, and hopefully we won't.
Sure. I guess that just means that you wouldn't be able to reduce the number of staff in store just from a safety aspect. So that's probably gives you a little bit less flex on wage costs looking forward.
Yeah, I think so. Well, we never have. We very rarely have any store with just a single person in store at any rate. But yes, I mean, so far it has not affected our rostering methodology to this point.
Terrific. Thank you very much.
Thanks, Garth.
Thank you. Our next question comes from Chami. Chami, please go ahead and unmute yourself to ask your question.
Thank you. Good morning, Matt and Dan. Congratulations on some of the announcements today. Good to see. Maybe starting off with the outlook, just to add on to the previous question as well, considering the a bit more than usual skew in FY25, could you talk to sort of, when you earlier said first half to be a bit consistent and then second half growth? Could you elaborate here? Thank you for EBIT.
Yeah, look, there's not much more to say, Chami. I think then, if we look at I'm going to say a normal split of first half, second half profit, and we have a look at what happened in the second half last year, and I'm going to say project through based on the comp sales that we're expecting in the first half, and margin and cost of doing business, that growth in the first half on the first half last year, which was actually pretty solid, particularly in hindsight, we think will be challenging. So we're just trying to set expectations. First half this year, we're expecting to be flat, and that's what we're targeting. And growth in the second half the second half this year against what was, frankly, a disappointing second half.
Also, Chami, I can add that, as I said, we're quite pleased with what we're seeing with forward orders on wholesale. It's been quite positive, and hopefully that'll hold up. Obviously, led with Skechers and Hoka being our two biggest brands. So that's really a good sign for us.
Great. And then just on that lifestyle and obviously macro would be a bigger beneficiary there than the sports brands. How do you feel about the outlook through the next few months or even a bit longer term?
Look, I think it all comes down to, what's the economy doing and so on, but there's good momentum. Certainly, we've seen good momentum. One of our strongest banners at the moment, Shami, is Platypus. In the past 7 weeks, we're very pleased with that. Our Hype business continues to hold, which is great. Where we are facing some challenges is with Vans, which we've called out over the last couple of years. It's been very soft, but thankfully, the new products that have come in, like Hoka and so on, has been really, really, really positive.
Perfect. Thanks for that. And secondly, from me, looking at the new store number for FY26 out of Sports Direct at least 30, what are you prioritizing here outside that key banner, outside the key Sports Direct banner?
I think there's still great growth in larger Skechers stores where we've tried a couple. They've been solid. Given what's going on with Anything Sport, and we're very happy with what's going on in Athlete's Foot, we will look to convert some of our current bigger stores into Athlete's Foot, and indeed look for new ones based on what we're seeing. I guess that's where the growth will be. But by the time you get 4 or 5 Stylerunners, 4 or 5 Nude Lucies, there's 10 stores right there. I think it's going to get down to, Shami, we're driving pretty hard negotiations with our landlords that if we can't get the right metrics, we simply won't do it. We're in no rush to just be out on a mad run to open more stores. They have to hit the metrics. But there's great opportunity. On top of that, we've opened a couple of Hoka stores in the last couple of weeks. One we opened yesterday, and we're seeing pretty strong results out of those stores. So there's a pipeline of stuff that we can do there. Also, I can add that we're in the market at the moment looking for Lacoste stores. So by the time you add all of those up, we should easily achieve what our aspirations are on new store openings.
Perfect. Thanks, Dan. Thanks, Matt. I'll jump back in the queue.
Thanks, Jamie.
Thank you. Our next question comes from Sam. Sam, please go ahead and unmute yourself to ask your question.
Oh, hi, Daniel. Hi, Matt.
Matt.
Just on the guidance, just to be firm, so it sounds like in the region of 118 to 120 of EBIT on the 110 is what you're thinking as high single digit, just given there was a one-off on the 110. So we're all on the same page?
Yep, that's a fair assumption, Sam, given the projection there for high single digit growth into FY26. Yep, mathematically 118 is high single digit growth.
Yeah. And can you sort of give further color on the startup cost? What that includes, marketing, team, and other components, and any numbers around that, just to help us understand what that is within that guidance. Thank you.
Yeah, no problem, Sam. Look, I won't provide any numbers. However, the types of costs that are incurred ahead of the curve are clearly standing up a team to get the stores launched. There's buying teams, there's planning that needs to be done, there's store operations, back-end warehouse operations. So there's quite a bit of investment that goes into that. Some of it CapEx, some of it OpEx. And then marketing is also a big cost when you're trying to establish a brand. So, in terms of I'm going to say the ahead of the curve components, those are the two you're dealing with. And if we're aiming to open 30 stores, over the next sort of 3 years, you can imagine that marketing isn't insignificant in terms of what we're thinking about over that period of time.
And when will that marketing start? Before the first launch, or will you wait till you get a few stores under your belt?
Yeah, concurrently it'll start with the first launch, but the investment around that first launch will be localized. Very focused on that store opening, and then digital. We expect the online site will open at around the same time, if not a bit earlier than the store. And performance marketing, other digital marketing, and then as the network starts to grow, we'd expect that marketing will be more broad based.
It's encouraging that you've locked in, or you're called out 4 stores and at least 4 stores. So sounds like securing sites so far as, you've got a good line of sight there.
Yeah, Sam, I've been quite surprised. It's amazing when there's no space, but then you get a hot business coming to the market. They tend to find the space. Yes, we've got many we're negotiating on at the moment, but we're being very picky, to be honest, of where we'd like to open, and of course we need the metrics to match. So at the end of the day, the consumer's going to vote. But I think what we've put together and what we're seeing coming from the Frasers Group internationally, we're excited about getting this one open.
Final question from me, just on it's encouraging to see lifestyle improve. Can you talk about whether that's product driven, macro driven, execution driven, or combination?
I think it's a combination, Sam. There's definitely more momentum. We felt it coming for the past 6-7 weeks. Our comps have improved, and there has been a little bit more of product innovation, and we're fairly confident of what we've seen in the forward pipeline from all of our brands, that there's good innovation coming, albeit a lot of it is sport inspired, and that's sort of what the market's wanting at the moment, and that's starting to bleed into the lifestyle space, which is good news. Part of the great results coming out of Hype is purely chasing that trend, and the likes of Platypus and so on are very close behind that now, growing in that area fast.
Thank you.
Thank you very much, Sam. Our next question comes from Ed. Ed, please go ahead and unmute yourself to ask your question.
Hey team, can you hear me okay?
Yep. Thanks, Ed.
Hi, thanks for taking the question. And it was good to see the EBIT coming at the top end of the guidance range. So I was just curious, given that you provided that in June, did anything change through June? Was there any improvement in the macro environment? And then have you seen any improvement in the gross margin environment, or is it too early to say yet?
So a couple of comments around June. You can deduct fairly easily looking at our trading update in June, and then the final comp number for the second half, that the last 3 weeks of June were very challenging. And that's like a little bit of a trend of what we're seeing in that lifestyle period, is when we go on sale, we're not getting the uplifts that we have seen in the past year or two. So that certainly happened. Now we'd seen that trend and factored that in, so part of the reason I'm going to say that guidance range was a surprise to everyone at the time was there was a projection in that it ended up coming true. So we didn't see anything we didn't expect, I'm going to say, in that last 3 weeks of June, which is why we were able to hit the top end of guidance. Look, I'm very reluctant to call out margin at the moment. We've said that we expect it to be around the same level as last year, and as we sit here right now, I'm very confident of that projection, but we're only 7 weeks in.
Okay, no, that's helpful. And then you've also talked to like-for-like sales return to growth in FY26. Just talk through what you think drives that. Is it more full price sales, more foot traffic? Like, which way should we be thinking there? I know you're kind of careful to say pull out margin now, but yeah, what's implicit in that?
think there's a couple of things going on in the macro. So I think certainly interest rates are going to start to help us. In the back end of last year in particular, we were cycling some pretty strong comps in Skechers from the prior year. That's now out of the base. And so that's positive. We're starting to see, as Daniel said, some positive momentum in Platypus. So there's a few things pointing to that lifestyle side of the business starting to recover, and certainly the forward wholesale pipeline being strong, we feel gives us a forward read, and it's as strong as we've seen it, for 18 months. So that's we see that as reflective of how others are sort of thinking about the next six to 9 months as well.
Ed, the other thing that we've been experiencing, which is great news for us in the industry, is the average transaction has gone up in many of our banners, particularly in the Hype and Stylerunner business. So that's really positive for us. A lot of the reason for that is because some of the shoes and the styles that are coming in have got some performance within them, and that obviously causes an extra cost and price. But there hasn't been the resistance that I thought we may get, particularly in the last, call it couple of months. So that hopefully will lead to an easier manner to chase the comps.
All right. Thanks for that color. And then maybe just one last one for me, and apologies if you've addressed this somewhere in the materials already, but just when you're in your comments, but the FX rate that you're looking to hedge for 26, is there any color that you can provide there?
So if you go to the chart that we provide in the back end of the slide pack, you can see that for the FY25 year, we actualized at around sort of that 66-65 level. Everyone could sort of observe as well as I can that over the last 6 months, the dollar's been bouncing around between 63 and 65. So you can imagine that any hedging that we've done would be at around those levels. And right now, if we're buying spot, we're buying it around those levels as well. So as we come into this year, it's fair to say that currency will be a headwind year on year. And when we talk about maintaining the percentage margin, what's feeding into that is we are hopeful at this point that the promotional environment won't be as severe as it was last year, with interest rates cuts and hopefully the household budget starting to feel a bit better. At the same time, Daniel talked there about ATVs increasing, so some price increases. And the other element is we're continuing to get benefits under the covers from the work that we're doing around vertical and distributed. And as Hoka grows, Skechers returns to growth this year, and with some other distributed brands coming in and the strength of Nude Lucy, that helps the underlying margin in the mix.
All right, thanks, team.
Yep.
Thank you. Our next question comes from Sean. Sean, please go ahead and unmute yourself to ask your question.
Great. Good morning. Can you hear me?
We can. Thanks, Sean.
Fantastic. Thank you. Maybe just to clarify the first half 26 guidance to be in line with first half 25, and I think this might have been addressed, but just to make it really clear, your first half 25 was 80.653 million. Now that included a 9.7 million gain on a reversible impairment, and then the 3.8 million impairment and a 2.6 million one-off. What is the dollar base that we should be looking for, please? Maybe you could just, it's a busy morning, so there's a good chance that I and others may, but certainly me, will get this wrong.
No, that's a good question, Sean. And when we talk about our results, we don't sort of talk in relation to underlying. It's just too complicated for everyone. So when we talk about flat, I'm talking about an ambition to be flat to the dollars that were delivered or the result that was delivered. So you could say that there's a small amount of underlying growth in that, but to not confuse everyone, it's the 80 million. And when we say that's there or thereabouts what we're targeting, that's the number.
Perfect. No, thank you for the clarity.
Yep.
Maybe
Yep.
just on CODB reductions, that the company had embarked on several sort of quite effective reductions in CODB above the store level. I'm just curious around the degree of cost savings that had been possibly realised. Maybe they needed to be reinvested in fiscal 25, and the degree to which any may come through in fiscal 26, please.
So we continue to drive cost efficiencies in a number of areas of our business. We're still through the period this year, we were cycling through the benefits of a support office headcount reduction, and we will get some benefits of that indeed. I'm going to say in the core business in the first quarter of this year. Offsetting that is that we've got startup costs associated with Sports Direct that are coming into the first half. But the program continues to try to drive costs and aim to drive costs, and we're having success in distribution costs, in marketing costs, in particular digital marketing costs, the amount we spend with Google and TikTok and so forth. As we have improved our owned channel data analytics, that's helping us target the 10 million customers that we have in our database. There is a constant battle at lease renewal that goes on to make sure that our occupancy costs remain in line as a percent to sales. You will see in the result there was deleverage in that in the second half, and as I've maintained, if we're not achieving low single-digit LFL sales growth, where you have 3 to 4% inflationary factors, it's quite difficult to drive leverage on that. So if you think about our cost of doing business and the statement that we are aiming to have cost of doing business broadly in line as a percentage with FY25 as we go into FY26, there continues to be a lot of work that has to be done under the covers to achieve that, albeit some of the inflationary pressures are starting to moderate a little. Having said that, it's a fact that the frontline team costs are going to go up at 3.5% again this year. And you need a couple of percent of comp sales, otherwise you have to take team off the floor. And as we heard from an earlier question, we're not in the business of taking team off the floor for safety, but as much as anything for customer execution and good store execution.
Great. And my final question is just on Sports Direct. Can I ask how you balance the requirement, and then maybe if you could amplify the requirement for Sports Direct for you to sort of sell brands that, be it sort of Slazenger, Everlast, Lonsdale, which have sort of more of a mixed reputation in this market, how you manage the requirement to sell those brands with selling the leading brands, and particularly doing the right thing by your own distributors in terms of sort of Deckers for the Hoka brand, which has been very well in terms of the distribution's been very judiciously managed in the appropriate sort of channels. I'm just curious how you sort of manage those sort of different requirements and how you put that into a store where you're sort of making each of those sort of different parties happy and having an attractive offer for the consumer. I'm just curious if you could talk a bit about that predicament that you face merchandising the store, please.
Well, I might have a first go at that. And I think the best thing to do is to sort of reference the Sports Direct's global model. And they're very much about, premium branded and value. And what you'll find in a Sports Direct store is you'll find a terrifically branded Nike concept footy area, which is going to have the best Nike boot on the wall, and we will have that in Sports Direct. And then, for the parent that comes in and then wants, a kid's boot, we will have a very keenly priced Syndico footy boot, which is a brand that we're going to make great margin on, and the customer will see the value. So that's the global model, Sean. So I don't want to say too much more other than we're going to execute what Sports Direct do and what the brands around the world appreciate them doing.
But Sean, I think it's a good question too, and obviously, that was one we looked at before doing anything. But the support from all the brands, including the distributed brands that we distribute, has been nothing short of great. And from our own point of view, I mean, the brands that we sell, the buyers will simply go and buy it based on the merit of the product. But all of our brands that should be in a sport store will be in the store and very strongly represented.
Fantastic. Thanks so much, Matt. Thanks, Daniel.
Yep. Thanks, Sean.
Thank you. Our next question comes from Sam. Sam, please go ahead and unmute yourself to ask your question.
Thank you very much. Hi, Daniel. Hi, Matt. Thanks for the presentation this morning. This is probably one of the softest periods I've seen Accent go through for some time outside of COVID. And to your credit, you've managed costs very, very well in this period. But my sense is a lot of people have left the business recently. And from all the broader cost out initiatives undertaken, what's the risk here that when conditions rebound in the lifestyle footwear space, you won't have enough people to see the leverage and execute on the way back up? Or will you end up having to put back in a lot of the costs that you've taken out in recent times?
Sam, that's a great question, and a couple of aspects to that question. So if I think about the customer-facing aspects of our business and the engine that drives, what we do with customers, both being retail customers and wholesale customers every day, that's not the areas that we've pulled back. And in fact, our team levels in store managers, assistant store managers, area managers, and we haven't touched those ranks at all. And what we've aimed to do is look at support office functions predominantly, where we've been able to put in more efficiency initiatives. We've been doing offshoring as well into Vietnam and, in fact, more recently into Manila in the Philippines. And we're finding great cost efficiencies in, I'm going to say, support office team doing, repetitive type tasks, data-driven tasks, and we've found some great savings through that area. So I don't think we'd feel uncomfortable that, where LFL sales go, there should be good leverage on that for us.
Okay.
Yeah, and Sam, I can only add that I don't think the exercise was simply just to take people out. It was more of an exercise to say, well, what do we look like if we start thinking about right-sizing the business from a people point of view? I think we're largely there, and I think particularly my management team, we're in a great place. So I don't think that certainly won't be an excuse if we can't execute. It won't be from lack of people.
Sure. And then can we explore the theft issue a bit more? How's this Victorian crime situation impacting your thinking around how many Sports Direct stores you want in Victoria, or the rents you can afford to pay in Victoria, unless the police and courts start to clamp down on this issue, given the types of products in a Sports Direct will be much more susceptible to theft than your pure play footwear banners? And Daniel, maybe it'd be good to get your thoughts on, do you think the retail industry is doing enough effective lobbying of government to take this issue more seriously?
I don't think we've done enough as an industry. No, I think we need to do more. It's all over the news. It's all over the social media. There's without any doubt issues, particularly in Victoria. And I hope the people that are qualified will do something about it. Like all the other retailers out there, the likes of JD Sport, Anaconda, and so on, we will simply follow the model of what Sports Direct are doing internationally. And on the main days, I dare say we may end up employing, a security guard, security at the front of stores. That seems to be a model worldwide for these big stores. So it's an area that we're going to learn and fall in line with. However, a lot of the stores, the way they've been designed, we will have team placed at the front of the store as well, proper rostered teams. And again, it's nothing new for us. It's where we're taking lead here from Sports Direct International.
Got it. All right. Thank you.
Thanks, sir.
Thank you. Our next question comes from Wei Wang. Wei Wang, please unmute yourself to ask your question.
Yeah, thanks, guys. And apologies if this has been asked before, but on your guidance assumption of flat gross margins, what have you assumed regarding promotional activity in FY26? Is it flat because you're comping an equally promotional FY25, or are you assuming in flat guidance that FY26 will be less promotional?
Look, it's impossible to know, but broadly flat. We think we might get some benefits in some periods in respect to margin against last year, but broadly flat. I'll tell you in January.
Okay. And then I guess with the Sports Direct rollout, I appreciate you haven't even got a store up and running yet, but have you seen or heard of any sort of competitive response to the planned rollout?
No, but not at all. We still supply competitors in the space, and there are many. If anything, forward orders have been quite strong. So I think there's, I think we will have a point of difference of what we're going to market with. We're quietly very excited about what's going on with Sports Direct. I'm not sure we've sold how good we think it is based on what we're seeing overseas, but it's terribly exciting what's happening in that space for us.
Okay, cool. Thanks. That's all from me.
Thanks, Bowen.
Thank you. Our next question comes from Aryan. Aryan, please go ahead and unmute yourself to ask your question.
Hi guys, can you hear me?
Yep.
I hope you're well. Just one for me, just the store guidance, 30 new stores. What's the assumption around store closures into 26? And sorry if you've already answered this.
No, that's a good question, and we haven't answered it. So we haven't put out any particular targets around store closures. The way we think about store closures and the way to think about them is as follows. So mathematically, with our portfolio size, every year we have 150 plus renewals that have to be negotiated store by store and site by site with our landlords. And our objective is that as we project out the sales of that store over the renewal period and what we think the EBIT's going to be, we have to be confident we can make a return on investment. And ultimately, we know pretty well what the sales are going to be. So the balancing number is the rent. And where we can't achieve the rental outcomes that we need, and then that store has to close. And we're quite disciplined about that. One of the reasons for, I guess, breaking down the closures we had in FY25 was to give you a sense that, roughly 18 stores closed in FY25 as an outcome of those negotiations. And, as a portion of the renewals we were doing, you can estimate that that's about, 10%. So that's I can't project what is actually going to close because it'll be an outcome of all of those negotiations as we get into this next year. They're going well. We're actually getting more wins than not in that space, which is terrific. But there will be some that close. And we've got another 150 renewals to do over the next 12 months.
And with those stores that you're closing and you typically close, are they EBIT like positive stores? Or are they all loss making, and so you actually get a benefit in the P&L when you close it, or is it just doesn't make a difference?
Typically, they're loss making or very marginally profitable is the answer. So that's where you close 18 stores that aren't great, and you open 54 that theoretically should be and generally are, and you should get a benefit from that overall.
Cool. And then in the accounts, there's a $3.5 million gain on lease modification. Like, what's that in this year, and is that factored into guidance when you're looking at the growth and the sort of drag you have on year-on-year growth, please?
Look, without sort of speaking specifically to that gain or other, I'm going to say one-offs that were in the P&L, that goes back to the answer that I gave earlier. We don't tend to, look at, one-offs and worry too much about them at that sort of level. So in terms of the guidance for next year, again, it's on the dollars that we delivered this year. In any given year in a business our size, you're going to have some things that are positive and some things that go against you, and on balance, they tend to even out over the continuum.
Great. Last one quickly. The second half 25 result, in my mind, you would have had costs associated with Sports Direct in terms of just the due diligence ramp up of it. Like, to what extent did that dilute your performance? Because that's not an underlying cost. I guess you haven't generated revenue out of that yet. And to what extent is Glue a drag on your EBIT this year as well, please?
Yep. So in respect of Sports Direct, immaterial in the second half, which is why we sort of haven't called anything out in the accounts in respect to that. But clearly there'll be some transaction costs associated and so forth, but nothing that's worth shouting out. Glue remains a drag on the EBIT for the second half, and we'd like to be able to say that it's better, but it was loss making in the second half.
Great. Thanks, guys. Appreciate it.
Thanks.
Thank you. We have a follow-up question from Garth. Garth, please unmute yourself to ask your question. Garth, can you hear me? You just unmute if you can hear me. It looks like Garth might be having some audio issues, so I will just remind our attendees, if you did have a question, please use the raised hand function. I'll just pause briefly to see if we have any additional questions from our attendees.
Hello.
Hi, Garth. We can hear you now. Thank you.
Yeah, you can hear me? Oh, terrific. Thanks
Yes.
for taking the follow-up, guys. Just on the loyalty program, it looked like there was a partnership with Live Nation recently. Could you just talk to whether there's a big cost to yourselves to do that, and any margin impact that we should expect, or if that is and just how maybe the response to that has been?
Yes, there is a cost to that. It's within the Platypus budget in terms of what they're doing with their marketing spend. In terms of what it'll do for us, it's essentially Platypus teaming up with, the music side of what happens in the youth market, in the youth area, and Platypus has always been synonymous with what goes on with music. So it's just an exciting time, but yes, there is a cost, Garth.
Okay. And then maybe if you just one last one on Sports Direct, just the license or the royalty fee that you've got to pay them. Can you give us a sense of how impactful that is going to be to your gross margin going forward? And previously you'd highlighted a goal of hitting 57%. Is that 56.5 as a result, or can you give us a sense of that?
So that I'm going to say target that you referred to is at a group level, being 57%, and I don't think we're backing away from that ambition, in the mix of our overall business. Having said that, if Sports Direct does what we want, it may well be difficult to get to that sort of percent, but that won't be a bad thing. I'm not going to comment on the royalties, other than we feel as though we're going to be able to generate a decent gross margin in the Sports Direct business because of the mix of our distributed brands and the Frasers brands and what they'll do in that business.
Terrific. Thank you.
Thank you very much. And we do have a follow-up question from Wei Wang. Wei Wang, please unmute yourself to ask your question.
Hi, guys. Yeah, just wanted to go back to guidance again very quickly. So high single-digit growth, it's not necessarily dissimilar to kind of where the market is at the moment. Just really want to understand, I guess, what your confidence level is of achieving that. And then the other thing, follow-up question was, you guys don't typically give guidance a year ahead. I guess why have you decided to give guidance this time around?
Yeah, so that's a really good question. I'm happy to answer that part of the confidence level again. I'll tell you in January, but if we didn't have some confidence, it would be irresponsible for us to put that out today, when. So I'll leave that there. The reason that we've elected to put guidance out this time is to make sure that we're not dealing with, I'm going to say, overambitious forecasts, and we wanted to base everyone realistically around last year. Is seen as a new base for us. And we had hoped that wasn't the case as we set our objectives for FY25 off FY24. However, it's clear that it is. And we wanted to flag very strongly that people should only expect high single-digit growth off that and not more. And indeed not less either, by the way. Yep.
Okay, cool. Thanks so much.
No problem.
Thank you very much. As we have no additional questions, that brings our Q&A session to a close. I'll hand back to the Accent Group team for any closing remarks.
Thank you all for your time, and hope you have a great day and a great weekend. Thank you.